All right, I'm helping a client analyze a quad unit in Maryland. It's about $500,000. And so looking at this from a standpoint of putting 20% down, maybe need to put 25% down. We're going to be doing a DSCR loan, so debt service coverage ratio loan, looking at just the investor cash flows, not your traditional conventional loan. So this is something that can actually close in an LLC. I use their interest rate as 8.625. It's just a round number. Don't take it as an actual quote. It's just for example purposes. Um, in this market, rates are going to be all over the place depending on a bunch of different variables, points, credit scores, DSCR ratios, et cetera, et cetera. So one of the things that I do is I take, to use a round number, is I take 40% off of the top of gross revenues. And so this listing doesn't have rent rolls or NOI and operating expenses. And one conservative way is just to take 40% off the top of a gross rent. So multiply the gross rents by 60%. And then from there, take that number. And if that covers the mortgage payment, then maybe it's worth digging deeper on the deal. And so if you go line by line here, so 500,000, we're assuming 20% down, $400,000 loan amount, 8.625 rate, 30-year term. I took out the depreciation stuff, zeroed it out, netted it out. And then what you see here is the rent. So 5,000 of rent annually, it's 60 grand. Taking a vacancy percentage of 6%. So that's going to take some off the top there. And then as you can tell, total operating expenses is 24,000. And what I did is I pulled in taxes, ballparked utilities, ballparked homeowners insurance, and then this 13,700 in repairs and then utilities. These numbers together basically kind of get us to that 40% number. So if I take 60,000 times 0.4, that's 24,000. So the utilities, I'm basically using $300 a month, assuming, water, trash, pickup, snow, all that, yard, all that stuff into there. But annual repairs, this could be overestimated, but I just basically pulled that number in, took these numbers, subtracted out from 24,000, and that left me with 13,700. So that gets me to that 40% expense ratio. So what you can see here as you scroll down, the cash flow for the year is negative 4,600, negative 388 a month. And so again, maybe we're being aggressive on the expenses. The list price is 500,000. So, and it's been set on the market for a while, for over 100 days. So what I did from here is I then said, okay, well, what if we put 25% down right here? What does that do to the cash flow? It goes to 195, a negative 195 a month from 388 a month. Okay, so well, what if we tweaked and pulled another lever? What if we went to 20% down again, but lowered the price, and maybe we got the seller to come down on price to 475? That brings us down to 234. So 25K in price reduction essentially, only lowers the payment by a couple $100. Kind of crazy when you think about it like that. So there's a couple of different things that you can look at with this. If you're talking about rents, 60K, well, are those rents even accurate? What I did is I pulled some data from Bright Investor, one of the tools that I subscribe to, and I didn't really want to give away the deal, so I moved this over here. And this is in Maryland, 2 beds, and when you run the map, $1,300 for 2-bed rentals. So really 1,300 times 4. 5,200. So I mean that gets us kind of in the ballpark of that $5,000 a month. So there may be some room to improve. Maybe you put some money into this and you push rents and get to the higher end of that over a period of time. So that's something to be aware of. So I'm going to pull up a different tool that looks at this kind of from a longer term perspective. And this is looking at this from a 10-year horizon. So you're going to have your negative cash flow. It takes until year 4 to get the cash flow positive. And then this is MBS highway. So over 10 years appreciation, 220,000, pulls in expenses, net profit. So this is looking at this over a total horizon, of your cash in, appreciation, cash flows. So average annual return, 13%. And again, this is not going to include any type of depreciation. So any depreciation would be on top of this. And so, the variable of the 13,000 in repairs, I mean, maybe that's excessive. I'm not sure, without really seeing the property. But let's just say that, you look at 13,000 a year, 1,400 a month, let's say that it comes down to 700 a month after the property is stabilized. So at that point, you've got some positive cash flow, and that 220 number of net profit all of a sudden, over 10 years gets into the 300s. And so that 15% would be your annual compounded return. So again, you can mess with the data with these tools. The goal is just to kind of get you in the ballpark to figure out, well, do I put an offer on the property? What levers do you pull? Do you try to buy the rate down? Do you try to, put more maybe you put more money down? Do you, try to get the price down? Have the seller cover the closing cost? But from a DSCR standpoint, those expenses that I have in there, they're not going to be part of the equation. They're looking at just the principal, interest, taxes, and insurance versus the rents. So this would probably pass the DSCR metrics, which is again, just gross rents minus your mortgage payment. And if it covers that, then you're going to be have more options. There are options available below the 1 DSCR, which is rates are going to be higher. So again, super simple, quick, brief overview of this. More things to dig into on the property. What's the status of it, inspections, et cetera, et cetera. But this is a quick overview of some data on how I look at this from a high level.